Welcome to the Investing Insights podcast from Morningstar.com. In this week's podcast, Russ Kinnel reviews changes in the mutual funds industry in 2019. Christine Benz provides a tidy way to tackle your financial to-do list over the year. Robby Greengold discusses Fidelity's highs and lows in the past year. Equity analyst Erin Lash shares why Kraft Heinz is worth considering. And our equity analysts examine the utilities, integrated oils, and midstream industries through the lens of ESG. Let's get started. First, Russ Kinnel reviews changes in the mutual funds industry in 2019.
Hi, I'm Christine Benz for Morningstar.com. As 2019 winds down, most mutual fund investors can look back on what has been a pretty good year for the markets. Joining me to provide a recap of the top headlines in the mutual fund world is Russ Kinnel. He's Morningstar's Director of Manager Research. Russ, thank you so much for being here.
Glad to be here.
Russ, let's start with a sad story. Jack Bogle passed away in early 2019. That, you say, was really the biggest news item from the past year in the mutual fund world. Ben Johnson also cited it as the top story in the ETF space. Let's talk about why Jack Bogle was such a seminal figure in the investment industry.
Yeah, well, he seized a really rare opportunity to create a mutual fund company owned by fund holders and really create this incredible tight bond between fund owners and the fund company. And of course, was a pioneer in low costs, in indexing, and I think really set the standard in a lot of areas for the fund industry. And I think even if you don't own a Vanguard fund, you may well have benefited from what Bogle was able to accomplish, because I think he really set the standard, and it was tough for the rest of the industry not to live up to that. And so I think it's really an amazing accomplishment. And we think back, even in the 90s, Vanguard was not that big a fund company. So really, it's still a little recent development, even though today it might seem like that it's always been the case.
And one thing that we're continuing to see is just these massive inflows into very low-cost products, mainly passively managed funds, where, of course, Vanguard is a leader, and out of some of the more costly, actively managed products. Let's talk about that phenomenon in 2019. It was certainly a major one.
Yeah, that story has continued. It's really been running since the bear market of 08, 09, when a lot of people gave up on active management, and we've really seen that grow, as obviously the ETF industry has grown alongside that, because the ETFs have drawn a lot of that passive flow. So yeah, it's really a big story. An interesting wrinkle this year is we saw passive fixed income and passive foreign equity start to gain some traction too. Not nearly as much, but generally those have remained the domain of active management. But recently we've seen a bit of a shift there, and that could be another challenge for active industry.
Okay, let's discuss performance. I kind of tipped it off at the outset. We have had a really great year in the markets. Can you summarize what has worked especially well for fund investors in areas that maybe haven't performed as well?
Yeah, so you may recall 2018, the market lost about 6% of its value, and in a way it's not uncommon to rebound from a down year with an up year, but I think the magnitude is surprising, right? You're up 30% in large growth, about 25-26% in large blend, so really a pretty strong rally. Also, of the 108 Morningstar fund categories, 106 gained ground in this year. Only bear market and ag commodities, two very small categories, lost money. So really you made money in everything, which is great. Obviously among the leaders, large growth up about 30%. The other side of the small style box, small value, was the weakest at about a 21% gain, though that's not as big a gap as we've had in other years, and values had some moments this year. But again, tech did particularly well. Healthcare did almost as well. So in some ways, it's the same story.
Okay, let's discuss some of the news within and among fund companies. One of the big stories was Invesco's acquisition of Oppenheimer funds. I'd like to get your take, Russ, on whether you think this is a good thing, whether you think this combined company is going to be a strong entity.
Yeah, I was out visiting Oppenheimer not too long ago, and it's interesting to see the change. I think for investors right now, it's still pretty much a neutral story because all the good managers, for the most part, are staying where they are. They've started with some open-end fund mergers and just announced a raft of ETF liquidations on the smaller ETFs they're killing off. But for the most part, the changes are more dramatic behind the scenes, like back office, sales staff in some areas where they're making significant cuts. On the investment side, for instance, and a lot of the Oppenheimer managers and analysts they wanted to keep, they signed to commitment for a few more years with added pay, and so I don't expect really big changes. And from a big picture standpoint, it seems fairly neutral to me. I don't think the funds will change much. I don't think we'll necessarily see big fee cuts, which I would love, but
Right.
I don't necessarily expect that.
One thing we saw were sizable capital gains distributions from some of the funds where there were changes, and that in turn triggered some reshuffling of the portfolios, and some of these distributions got paid out.
That's right. In some cases, they moved a fund from an Invesco team to an Oppenheimer or the other way around, and then said, okay, run it the way you ran this other thing. And so they did that, and that meant getting rid of all the holdings in the old portfolio, and that meant a lot of cap gains. So you're right. In one way, it is a negative if you held some of those funds in your taxable account.
Okay. Another story that you think is significant is Henry Ellenbogen's departure from T. Rowe Price. He had been running T. Rowe Price New Horizons. Let's talk about that, where he went, who's taking over, and how that affects you and how you and the team look at that fund.
Yeah, we talked about how it's been a challenge for active management, but certainly some active management is thriving, and T. Rowe is one of the firms that's really had a great decade because they've had a lot very good stock selection. They're well managed and pretty good at communicating with shareholders. But this is a tough one because Ellenbogen ran T. Rowe New Horizons, which is a mid-growth fund, very big one that's had tremendous returns. Has kind of been a leader on some of their private equity investments. And so to lose someone kind of mid-career is really tough because there are other T. Rowe managers who are relatively close to retirement. And so in a way they could have been expected to lean on Ellenbogen even more. So it's tough to lose someone mid-career. But of course, when you're a really successful growth manager, there are a lot of possibilities out there. You can do hedge funds, venture capital. There's just a lot of possibilities. So it's tough to hold on to him, but it is a blow for T. Rowe.
Do we know what Ellenbogen will be doing?
He's starting his own firm, so not one that individual investors can invest in, unfortunately.
Okay, Russ. Thank you so much for being here to recap the past year in mutual funds.
You're welcome.
Thanks for watching. I'm Christine Benz from Morningstar.com.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit Morningstar.com/Alexa.
Now, Christine Benz provides a tidy way to tackle your financial to-do list over the year.
Hi, I'm Susan Jabinski from Morningstar. If getting your finances in order is on your 2020 to-do list, you're in luck. Morningstar's Christine Benz has put together a month-by-month to-do list to help make that job more manageable. She's here with me today to discuss that list and take a closer look at the jobs for January. Christine, thank you for joining us today.
Susan, it's great to be here.
Now, you've been doing these month-by-month calendars for several years. Why?
Well, I think one of the key reasons I like to do it this way is that some of these tasks, like getting your financial house in order, can seem kind of overwhelming and daunting. And so what I've found, certainly in other aspects of my life, is if you sort of take a look at a task and if you can break it up into more manageable sub-jobs, that can actually help you get stuff done. Mm-hmm. So that's the goal with plotting this on a calendar. And some of these jobs naturally lend themselves to the calendar. So around February, March, most of us do have our sleeves rolled up. We're working on our taxes. So we talk about tackling your tax jobs at that season. So we use the season to dictate some of these to-dos.
So let's look at January's to-do list, and topping that is something you call a wellness check. Let's talk about that.
Right. I think a lot of us come into a new year, we're thinking big picture about our lives, areas that we want to improve. So I think it makes sense to think about your financial life in a big picture way in January as well. Mm-hmm. So you just want to ask that basic question, how am I doing? And try to answer it. So depending on your life stage, if you are someone who's still saving for retirement, really the key gauge of how you're doing is what your balance looks like, and also what your savings rate looks like. So here I would say use a good basic retirement calculator just to see whether you're on track with your retirement savings. I've often recommended T. Rowe Price's retirement income calculator. Vanguard has its nest egg calculator. A lot of the big financial firms have very good calculators that allow you to plug in some variables and come out with kind of an estimate about how you're doing. But you do want to look at that savings rate. If you're in a position to nudge it up, and since we've been in the midst of a strong economy, some people have gotten raises, look at whether you can, in fact, contribute more to your accounts for 2020. I think that's kind of a key headline for people who are still in retirement savings mode. For people who are already retired, really the key gauge of your portfolio health and your overall financial wellness is just whether with whatever withdrawal rate you're using from your portfolio, whether that's sustainable over your retirement time horizon. There are certainly a lot of ways to think about that. Many people have heard about the very basic 4% guideline, but just check and make sure that whatever you've withdrawn from your portfolio over the past year kind of passes the sniff test of sustainability. If you are looking at your balance enlarged, chances are, unless you've been wildly overspending, you've probably been staying in line with a sustainable spending rate. But think about what you would do if the market turned down and your portfolio balance shrunk. Make sure that you are not overspending in such a period. So do a check on that, and also think about what you would do if your portfolio took a nosedive.
Another sort of big picture January to-do that you talk about is whether you're maximizing the return on your total financial capital. What does that mean?
This is something that I think is under-discussed, but we all think about kind of maximizing the return on investment of our investment portfolio, but most of us have other items on our financial ledger. So maybe you have a home mortgage, or maybe you have student loan debt. You have other things that are bidding for your financial capital, and so I think you want to think really big picture and think about whether you are maximizing your return on investment. So a really easy example would be if you have high interest rate credit card debt. Well, there's almost nothing you can do at the portfolio level to out-earn that interest rate that you would get by paying down your debt. Right. So it gets a little more complicated when you're looking at more benign forms of debt. So maybe you have a home mortgage where your interest rate is 3.5%. Well, rather than shoveling additional funds into your cash account, maybe there you're better off prepaying that mortgage, assuming you plan to stay in the home and don't need the liquidity and so forth, then shoveling more into your cash account. So think about your balance sheet, your total financial picture in aggregate, rather than thinking about just maximizing ROI on your investment portfolio.
At the portfolio level, yeah, that makes sense. So for those folks who are contributing to a retirement account, now is a good time to sort of look at their contributions. And those limits have changed for 2020, is that right?
They have for company retirement plans. So if you're under age 50, the contribution limit is going up to $19,500. If you're over age 50, it's $26,000. So take a look at whether you can adjust your contributions, especially if you're in a position to hit those maximum allowable contributions. One thing to think about, though, Susan, if you're also earning matching contributions, and especially if you're a high-income earner who earns a bonus, and this is starting to be bonus season, just make sure that you are not over-contributing to your company retirement plan too early, because some companies require you to contribute throughout the calendar year to take full advantage of the match. So just check that, make sure that you're not overfunding your 401k, hitting that limit too early, and thereby shutting yourself out from some of those matching dollars.
Another item that isn't officially on your January to-do list, but that you've talked about before as being something that makes sense to do in January, is to revisit your asset allocation. Do you feel like that's any more important this year than previous years, and why is it important in general?
Well, I do think it's important, and I think it is more important in 2020 than it has been in previous years, mainly because we just saw such tremendous equity market performance in 2019. So people who have been hands-off with their portfolios, who haven't revisited their asset allocations recently, are likely to find that their equity weighting is heavier than they might wish. And this isn't a big deal for people who are still really ramping up their retirement savings, have many years until retirement. I think it's a more important consideration for people who are getting close to retirement, who might retire within the next 10 years or maybe even fewer, or people who are already retired. I think it makes sense to take a look at that portfolio's asset allocation. Make sure that you have enough in safe securities like cash, like bonds, to tide you through a weaker period of performance. And I think it's a way to just kind of take a step back, essentially harvest some of your winnings, because it has been such a great market for so long.
And Christine, are there any changes going on with IRAs for 2020?
Well, there are big changes related to the Secure Act, which we'll be covering in various ways on Morningstar.com. But in terms of contribution limits, no. They're staying the same as they were in 2019. So that's $6,000 if you're under age 50, $7,000 if you're 50 plus. This is a great time to think about spacing out your IRA contributions throughout the year, maybe putting those on autopilot. So if you're under 50, it's easy. The math is easy. You've just got to contribute $500 a month to hit that $6,000 annual contribution limit. And I think the virtue of that is, one, you're spacing your contributions throughout the year, and so you're not necessarily putting all your money to work when the market is high. And the other benefit is just that it's more manageable, that coming up with $6,000 can be kind of a heavy lift around tax season. But if you space those contributions throughout the year, I think it can make it more manageable. So take a look at that. I like the idea of automating those IRA contributions.
Christine, thank you for joining us today and for giving us a roadmap for getting our financial house in order over the course of the year, but specifically in January.
Susan, thank you so much.
I'm Susan Jabinski from Morningstar. Thanks for tuning in.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Next, Robbie Greengold discusses Fidelity's highs and lows in the past year.
Hi, I'm Christine Benz from Morningstar.com. In a strong year for stocks and bonds, Fidelity funds have generally posted solid performance. Joining me to recap the year at Fidelity is Robbie Greengold. He's a senior analyst in Morningstar's Manager Research Group. Robbie, thank you so much for being here.
It's my pleasure.
Let's start with a piece of news that has been kind of swirling around Fidelity. It has been a holder of some of these private companies, one-time unicorn companies that have run into trouble. Let's talk about that. Let's talk about some of the names, some of the private names that the funds have held, and also just how big a deal this has been for performance.
Well, what immediately comes to mind for me is the relentless news this year about WeWork and its failed IPO. This is a company that Fidelity has invested in the past, and the market has seemed to be scrutinizing Fidelity for its involvement with the company. And the company has shelved its IPO for now. The market had scoffed at its valuation, and Fidelity has since marked down its own valuation, and it had marked down its valuation before the real headlines started splashing across everybody's newspapers. But I think it's critical to point out that some of these unlisted companies that Fidelity invests in are really they're mostly very small portions of any individual portfolio, and Fidelity uses these to get in early to these rapidly growing companies. In these early stage companies, Fidelity is trying to exploit its capabilities and take advantage of that opportunity to invest in high growth stories. So for example, when you think about Fidelity Contra Fund, which is by far the largest of the equity funds at about $120 billion in the fund alone. Contra Fund invested in WeWork in 2015, and Fidelity began getting involved in WeWork according to PitchBook data going back to 2012. So this is before the company had even begun to really get into its significant growth phase. And so it's not the case that these private companies are necessarily going to be so risky that investors should stay away from the funds. The managers are managing risk well, and some of these portfolios have benefited tremendously. Fund holders have really benefited greatly, particularly in a fund like Fidelity Advisor Growth Opportunities, which we now rate bronze. That's a fund that invested early, actually just a couple of years ago, it invested in Juul Labs, which is privately held, and the strong performance of that holding alone was a key contributor and has been a key contributor to performance for that fund.
Okay, but Juul is another one of those high-profile debacles, really, where there have been some major health concerns around.
It's been controversial. Yeah, this is a maker of e-cigarettes.
Right.
It's had regulatory headwinds, et cetera, and so these are volatile names. They're certainly of higher risk than other firms that are publicly traded, and the managers recognize that. But it's not typically the case that the managers are playing fast and loose and being irresponsible.
Okay, so the positions are really kept quite small. The idea is that some of these positions will be winners, some will be losers, but the positions are right-sized to account for that riskiness.
Yeah, well, part of the risk is the illiquidity of the positions.
Yes.
So Fidelity Advisor Growth Opportunities benefited so much from Juul, which started as something like 0.10% of the fund's assets, but it grew so much. It grew to become a top position, but the manager, Kyle Weaver, has been able to pare that back. So that there is that illiquidity, but the managers are handling it well.
Okay, so let's talk about fund flows. Fidelity has, for the past several years, been facing some pressure, specifically within its actively managed equity lineup. How has Fidelity done in terms of handling flows so far in 2019?
Well, when you think about assets, how assets are positioned today, right now the asset management division has about $3 trillion under management, and that's a record.
It's been a strong equity market, so that's lifted all boats, yeah.
For sure. And most of the assets continue to be in active equity, which continues to have pretty heavy redemptions. That's continued this year. But there's been strong interest on the passive side of the business. In 2018, Fidelity made a splash with its so-called zero index funds, which charge net expense ratios of 0, and collectively those have garnered about more than $7 billion in assets, but that's just a fraction of the net flows to the passives business. And so, when you look at how the firm has diversified its portfolio, it's true that it is still over-allocated to active equity, and particularly large cap equity, which is where the most severe redemptions are coming from. The firm has done a really good job of continuing to stay strong with its flows and with its asset base.
Okay, let's take a look at performance so far in 2019. As of here, we are in early December. About 55% of its actively managed equity funds are beating their benchmarks. Let's talk about that.
Sure. Yeah, performance overall across asset classes, it's been okay. In active equity, as you say, a little over half the actively managed equity funds are beating their prospectus benchmarks. About 2/3 of them are beating their categories. And so if we look at kind of the major funds that are part of that Fidelity Contra Fund, it's lagging its bogeys by a bit this year through November. And that's really nothing to be concerned about. When you look at the major detractor, it's really contra funds overweight in Berkshire Hathaway. That alone has detracted because, hey, the stock is only up by single-digit %, and that looks, kind of pedestrian in a market that's up more than 25% as of November. So contra fund is lagging a bit. Fidelity Growth Company, which is managed by Steve Weimer, we rate that strategy silver. That has had top decile performance through November, and that's been on the strength of stock picking. Shopify has done extremely well. Lululemon Athletica, another great pick. And Steve Weimer has held on to a considerable stake in NVIDIA, which had a rough 2018, but it has since come roaring back. And then when you think about going down the market cap spectrum, Joel Tillinghast, who manages Fidelity Low Price Stock, we rate that silver as well. That strategy has lagged a bit this year, mostly because of Tillinghast's embrace of stocks overseas that have underperformed. For example, he's allocated a bit over 10% of the fund to Japan and South Korean companies. And so, that combined with the fact that he typically holds about 6 or 7% cash, that's made for some underperformance there.
Okay. Let's talk about fixed income. Really quite a strong year there for its fixed income funds.
Yeah, we think very highly of the fixed income team. And we have a gold-rated fund, Fidelity Total Bond, which has had top third performance this year. But that's really not that unusual for the fixed income team, because about half of the fixed income funds have had top third performance. So there's been strong performance there, and it's just something to smile about.
Okay. Robbie, thanks for sharing your perspective. Great to have you here.
Oh, thank you, Christine.
Thanks for watching. I'm Christine Benz from Morningstar.com.
Now, equity analyst Erin Lash shares why Kraft Heinz is worth considering.
Kraft Heinz was once viewed as a darling in the packaged food space, but shares have soured, falling around 30% over the past year as the firm has failed to sustain prior operating margin gains. But we believe change is afoot, following the appointment of new CEO Miguel Patricio. From our vantage point, he may possess the recipe to whip up sales and profits for this no-moat operator. Patricio has been reluctant to formalize his strategic aims for the plagued business as of yet, but we posit that his extensive resume, including time as president of Asia and chief marketing officer for wide-moat Anheuser-Busch InBev, suggests he grasps the importance of consumer-valued brand spend. This would prove a shift for Kraft Heinz, where insufficient spend has impaired its retail relationships and brands over the past several years. Further, we believe new management is keenly attuned to the error in blindly rooting out costs, favoring sustainable efficiencies. And to foster enhanced financial flexibility, we think management will shun acquisition opportunities as it works to steady its ship and lessen its extensive debt load. Although we don't expect the ship to turn overnight, we think patient investors should serve up a slice of Kraft Heinz's shares, which trade nearly 40% below our assessment of their intrinsic value. Even on more traditional valuation metrics, the shares strike us as attractive at just 10 times forward 2020 earnings per share, a far cry from the mid-20 times where they traded at their peak, and below the 16 times average of Kraft Heinz's packaged food peer set.
Expand your investing horizons and look to the long term with Morningstar's new podcast, The Long View. Join hosts Christine Benz and Jeff Patek as they talk to influential leaders in investing, advice, and personal finance. Search for and subscribe to The Long View today. And lastly, our equity analysts examine the utilities, integrated oils, and midstream industries through the lens of ESG.
renewable energy in the U.S. is no longer just a side job for utilities. In fact, over the next decade, we think it's going to be one of the biggest growth drivers in the sector. What we're looking at is almost 8% annual growth in renewable energy, bringing renewable energy to almost a quarter of all electricity generation and demands by 2030. Some of the big demand drivers in renewable energy are going to be New York, which is aiming for 70% renewable energy by 2030, and California, which is aiming for 60% renewable energy by 2030. Our forecast just includes those state policies in place, and there's a lot more upside if the economics continue to improve and other states enact policies that would support renewable energy. There are several utilities that are typical renewable energy investors. NextEra Energy, Xcel Energy lead the pack, but we think there are several other utilities that can benefit, grow earnings, and grow the dividend based on their renewable energy investments. Some of those include CMS Energy in Michigan, Alliant Energy also in the Midwest, and Edison International in Southern California, where infrastructure is going to be absolutely essential to reaching California's goals. Utilities valuations are rich right now, but we still think there are many utilities that can benefit from the renewable energy investment growth that's coming over the next decade.
That does it for this week's Investing Insights podcast from Morningstar.com. We hope you've enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.